Today's video, I'm gonna be telling you exactly what futures are and how we make money trading them. If you are looking to start making money day trading or you're transitioning from a different trading market, this is the perfect video for you. All right, let's get started. So let's start off with what is a future. So a future is a contract to buy or sell a commodity, an asset, a security at a set date in the future, at a specific price. Now I know you're like, yo, where's the context? What does that have to do with anything? I got you. All right. So all of this came about a long time ago. All right. Before we were trading it on our phones. So let me give you an example. Let's say back in the day, you were a buyer. You're the owner of a jewelry shop and therefore you make money with gold. All right. That's how you make money. You take the gold, you buy it from a seller who is a miner. He has a mining company. That's your distributor. And you buy gold from him so that you can turn around and you can sell that, gold to me after you make it nice. For example, they buy gold from the miner and then they sell a chain. It takes them maybe $500 to make a nice Cuban, right? Nice chain. Then they go ahead and they turn around and they sell it for $2,500, right? So there's a $2,000 profit there. Now, what happens in the future? The price of buying gold goes up. Well, that's going to cut into their profit. Instead of costing them $500 to make the chain, it's going to cost them $1,000 to make the chain, which is cutting into their profit. So that means either now they just lost profits, they're losing income, or they are going to have to raise their prices on their customers. So futures was a way that business owners would hedge their risk. And hedge means that they would get rid of that risk, kind of go against that risk to make up for it. So how in the world? Well, what I could do is I can contact the miner and I can say, hey, let's sign a contract that says that I will buy 100 ounces of gold at today's price in 12 months, in a year from now. So let's say that today's current price on gold is $1,000 per ounce. Bear with me. That means that for 100 ounces, I would pay $100,000 to the miner. Okay. Now let's say that in 12 months from now, the price of gold goes from $1,000 per ounce to $2,000 an ounce. It literally doubled. That means that my cost to be able to make the chains and sell the gold is going to increase by double, like we just went over. So what I can do is sign a contract for $1,000 per ounce in a year from now. So that means in a year from now, even though the cost goes up to $2,000 per ounce, I get to still purchase it for $100,000 for that 100 ounces. Now the seller loses out here, right? So you have your buyer who wins that futures contract and you have your seller who loses it, right? Because say that the cost to mine gold goes up. That's the reason that the prices had to go higher. And now, even though they needed more of that profit, they now have a loss of 100,000 in that value of the gold. Now, in the other direction, say that the price of gold in the future actually goes down to $100 per ounce. That goes from costing $100,000 for 100 ounces to now $10,000. That's a $90,000 that the buyer now in a year, the price went down to $100 an ounce. But the buyer signed a contract that in a year, they will buy that gold at $1,000 per ounce. So even though for 100 ounces right now, they could pay $10,000, because they signed that contract, they still pay $100,000. So now that seller just made a profit because the value of their gold has gone down, but they still got paid that $1,000 per ounce. That's a $90,000 profit to that miner. Now, clearly in today's world, we are not taking delivery. That's what it would be called. As a buyer, in a year from now, I would receive that 100 ounces of gold, no matter what, at the price that I bought it for, which is that 100,000. So if in a year from now, the price doubled, like we said, for 200,000, I could literally sell half the gold right away and make my 100,000 back because the value went up, or I could sell all of it and I would make a profit. Or as the seller, you just got paid double for your gold. So now you can reinvest that, make more back on the business, whatever the case is. In today's world, you're not taking delivery on 100 ounces of gold, and nor do we really desire to. All right. So we trade what are called futures derivatives contract. A derivative means that we're not actually taking ownership of the thing. We're not actually buying 100 ounces of gold. We are trading a contract, right? A security. We're trading something that has the value, mirrors the value of gold online, right? Thanks to technology, we no longer actually have to take delivery delivery to make a profit. So let's say, for example, the same situation. You believe that in a year from now, the value of gold is actually going to go up. So as a buyer, you sign a contract, right? And you go into a futures contract right now for 100 ounces of gold. Let's say the current price was, it's not, but let's say the current price was $1,000 per ounce for gold. Now, in a year from now, when the price of gold, let's say, is at $2,000 per ounce for gold, the value of that 100 ounces is at 200,000, but you bought it at 100,000. Now, because we are not actually trading gold, we are trading a futures derivative contract for gold. Instead of actually receiving 100 ounces of gold, guess what you're going to receive? The difference. You're going to receive that $100,000 of profit. Okay, now let's be real. The majority of people are not going to come into this making $100,000 profit in gold off of one trade, but it's for the sake of example, and the numbers are easier. So that's how futures came about. But in today's world, we no longer actually have to take delivery of said item. Now, there's a couple different ways that we're able to participate into the futures market. You have, first of all, as a demo account, right? That's the first thing that you can do, is go make a demo account and start to practice these types of trades. Either way it goes, whether you do a live account or you do a demo account, you are able to open an account, what's called a broker. Okay, a broker is like your trading bank account, right? It's like your trading bank. Once you put your money into a broker, you are now able to take these trades. One of the beautiful benefits of futures is that you are able to trade with leverage. Say, for example, that same trade, you wouldn't have had to actually put up or have $100,000 to take that trade. Let's say that your broker offers you a 5% margin on that trade. So that means that as long as you have 5% of that $100,000 in the account, you can enter that trade. So let's say you have $5,000 in your trading account, you would be able to enter that trade and make that profit minus some, but you'd be able to make that profit without actually having put up all the money for that gold or having actually took delivery of that gold. It works the other way as well, though, and that's the risk. If you believe that the value of gold is going to go up over that time and the value actually goes down, you are now responsible for that loss, right? So you could end up losing all of your money, especially if your loss can't cover how much you were trading for. That's why a very big part of trading in futures is about risk management and protecting your money. That's rule number one. The other way that you're able to trade in these markets is what's called a proprietary trading firm, also known as a prop firm, versus a broker where I'm going to take my $2,000, my $5,000, and I'm going to put it in there for me to trade. With a proprietary trading firm, I can actually take a evaluation, I can take a test, and they will allow me to show my skill in trading by reaching a certain profit target on a fake account. If I reach that profit target, they will actually give me either live or simmed money to trade with that I will then make 90 to 100% of that profit I will get to keep. Now, there are rules to that because you have to pass the test. You have to actually know what you're doing. You have to be skilled at what you're doing in order for it to actually pay you out in money. You know, sometimes that can be a better opportunity than actually putting your own money up front. With that being said, that is a quick introduction to the futures market, what it is and how you actually make money by being a buyer, being a seller, how you can get started, you know, with a broker, whether it's a broker or a prop firm. There are some differences in other derivative contracts. Like I said, maybe you're coming from another financial market, maybe you're completely brand new. If you're completely brand new and you got value from this video, leave a like, subscribe, and comment any questions that you have. If you are not brand new, same thing, but you may be coming from the CFDs market, or maybe you're coming from the options market looking for more information on futures. So when I say CFDs are known as Forex. When people say Forex, they are talking about the CFDs market, and throughout all these markets you can trade similar assets. It's just the way that we're trading them is different. The futures market, just to name a few benefits, risks, with the futures market, you are trading in a fully centralized market. It's centralized by the Chicago Mercantile Exchange. That means that everyone is getting the same prices. Manipulation is not saying that manipulation doesn't exist, but it's not that every broker that you trade with or any entity you're trading with may have a separate agenda, right? Because everyone's getting the same price. Again, like we said, you have that leverage that is available in that market, and with it being a centralized market, it tends to be a bit safer for you to trade in that market as well. One of the downsides to futures is that you lack the flexibility in your risk. For example, trading NASDAQ 100, which is an index, all the contracts are locked in at $5 per contract. You can trade micro contracts as well, but it's a locked in price at what it is. There's not a lot of flexibility and versatility in the risk that you're choosing in that aspect. However, when it comes to CFDs, you're actually able to trade NASDAQ. You can customize your risk to even half of what that contract would be, a tenth of what it would be, however you want to actually manipulate it. So it's a little bit of flexibility in that. When it comes to CFDs, it's also a lower barrier of entry. For the most part, you know, people can get started with a very small amount of money and a very high amount of leverage. Two of the things to be aware of with the CFDs market is that at the end of the day, it is a decentralized market. So there tends to be a lot of middleman manipulation in the CFDs market. You tend to have a lot of manipulation from the brokers, from the prop firms you're trading with, whatever the case is. It's a lot of weird stuff. And when it comes to US citizens, there actually is a bit of a struggle right now to be able to trade in the CFDs market. You can trade with one of the 9 regulated brokers in the United States as a US citizen for CFDs. However, once you're trading with those regulated brokers in the States, it kind of loses some of the benefits that you were looking for when trading CFDs in the first place. If you traded with an unregulated broker, you would get some of the same benefits, but there's been a very big crackdown on unregulated brokers in the United States, so where most of them unregulated or brokers that are regulated in other countries but not regulated in the States are not offering services to US customers, which is what pushed me over to futures eventually, right? I traded CFDs for over 5 years, almost 6 now, but making the switch to futures was one of the best decisions ever for me. Options, I don't have as much experience with the options, but just know that futures is an obligatory contract, right? When you get into a futures contract, you have to buy, you have to sell at the end of that contract, whatever you decide to do. The options, it's an option. There's no obligation for you to fulfill that buy or that sell at the end of the contract. You also don't have the same level of margin or leverage when trading in the options market, so that's something to be aware of. That's a good introduction for you to the futures market. If you guys got value from this video, give a like, give a subscribe. Any questions you have, go ahead and comment them below. My next video, thinking about delivering how it is that I took $260 and grew it to over $10,000 in less than 23 days trading in the futures market, right? So if you guys want that video, go ahead and drop next in the comments and I'll get that out to you guys. I look forward to going ahead and continuing to provide value. All right, so with that being said, have a wonderful night or day, wherever it is where you're at. We'll see you in the next video.